Markets with Julian Brigden, co-founder of MI2 Partners. Hi, Julian. Welcome back.
Hello, Maggie. How are you?
Fine. Thanks for being patient, everyone. It's Friday, so technology always tries to get us in the end, but we won. We won today. A little help from some friends.
Yes.
Uh, so, Julian, we as the market wears, can you guys hear that noise? Okay, maybe it's just me. Hang tight. Somewhere, something is on. Okay, wait, hold on. Hold on, people. Okay. I don't know if y'all heard that, but it is Friday. So we have closing out the week. So we saw stocks take a breather. The mood in tech seems to have recovered. The Nasdaq up about a third, nearly 3% on the week, but it seems like a different picture over in bonds. The yields on the 10-year edge lower after that week retail sales, but the mood there seems nervous. What do you make of this market action, Julian?
So I think an awful lot of the stuff that we've seen at the start of this month, Maggie, has been positioning. So I think what we've done is, this is a very difficult time of the year for hedge funds because you kind of start the slate clean. And so the absolute thing you do not want to do is be down until you've accumulated a bit of P&L where you can start playing with the chips more freely.
Mm-hmm.
And so people try to play things very close to their chest, and I think we've seen quite a lot of position adjustment. I think a lot of people went into the end of the year, they were quite long dollars. Obviously we've seen that one shake it out a little bit. Whether that continues, I think, is open to suggestion. I think there are some things out there which could tell you that we've seen the high on the dollar for the year. Typically we make the high and or the low of the dollar most of the time, almost all the time, in the first quarter of the year. Of course, it's very difficult to know, if you've had a big high and a low, which one it is, right? But yeah, that's that. I think so. You get some adjustment there. I think people are probably were a little short US stocks. They were very underweight Europe. So when that sort of squeeze started back in December, they've chased it now. The question is there something more? So I think we're at a very, very interesting time. And of course, I mean, bloody hell, it's never been more volatile. I mean, the expression tape bomb has a new expression under our new president, right? This is insane. This is insanity. So I think, we have to try and look through some of the noise and try and figure out, and I think we were talking this, off air, try and figure out what the direction is and try and surf that vol around what we think is direction, whether we're right or wrong. That's the nature of the beast, right?
Yeah, and the one thing that we're hearing consistently is that we are in just a sort of a longer term volatile market. Like vol's not going away. This is just the
No,
nature of it. It's the
no.
nature of the administration. Maybe it's just the nature of the macro environment right now, but that is here to stay. So I think
Yep.
that the idea of surfing it in the right direction is about as good as we're going to get. It sounds like that means people are going to have to be a lot more nimble if that's the
And I
case,
think,
though.
yeah, and run less risk. I mean, ultimately, that's what it means. Because when risk is a function of what the model tells you, and that's a function of what the volatility of the underlying market is. So if we are moving into a structurally more volatile world, right, that has implications. It also has implications ultimately for some of the movements in the market, because you shouldn't get as much vol suppression. I mean, this is a big thing that happens. There's funds that just continuously effectively sell volatility, suppress and suppress and suppress. So we'll see, and I think that opens us up for some quite interesting moves.
Yeah, I think this environment should be good for folks like you, right? Like I think it's a little daunting for some people who have a longer term view, and it feels uncomfortable. But there are a lot of shifts around, which if you get them right,
Yeah, to the extent that yes, you're right. Macro guys don't really care which way it goes, up or down. The trouble is some of these moves are so disjointed that you can be in what looks like a winning position 1 minute, and the next minute some tape bomb hits and you get ejected via the sunroof, and in a James Bond-esque kind of way, right? It's challenging. It's challenging.
Yeah, I've had a few different people say to me this week, "I just don't know." I mean, really experienced people. I think because there are unknowns about the impact of policy.
Mhm.
And when you're talking about you think you have it right and then something else happens. So, hi everybody in the chat. I'm going to pull in one of these questions right away because I think this speaks to it. J&J asking, "Does anyone have any idea why all commodities got killed today, even though the dollar went down as well?"
Well, we've been very, very long gold for a long, long time. And we think some of the final up move is related to these sort of squeezes related to tariffs, some of the COMEX delivery issues that have been happening. We think this move is pretty extended now. I love it. I love gold, right? I say to people, I know Raul had his Bitcoin thing, but I'm like gold all the way. I do not want to sell this stuff. I think it's going materially higher. But if you run a trading book, we run an alpha capture book, we've taken most of our gold off the table at this point.
Ah, interesting. So you for this leg up, you feel like
But
it.
this leg up, I think, we have to wait to see what comes next. I feel very naked. I feel uncomfortable not having it. PA, I'm not. Trust me, I could stand up. I've got trousers on. It's okay.
That was our next question. Julian, everyone can be rest assured. Julian's got his trousers on. Thank goodness.
I'll do it at the end if you don't feel I've got a pair of jeans on, you're fine. I do think in my personal account I still hold it. I'm not trading it. I would want to buy more on the dip. But from a pure trading perspective, I think you've got to treat it differently.
Yeah. So Lena asking, and by the way, Lena's pointed out the gold silver ratio reached 92. You'll all remember Dal was walking through some of these levels he was watching, and he sent an update. A lot of them hit today, so be careful and watch that. She said, "Are you still someone's asking, are you still in your silver position?" Yeah, Lena.
No, we haven't had silver for a bit. It just I really want to buy silver. It's and it's a good question because I think this is an apropos time to sort of bring up that issue. Silver is a reflation trade, and it typically does well in an environment where the dollar is weakening and the Fed is cutting rates.
Mm-hmm.
The dollar is showing signs of potentially weakening. I don't think the Fed is cutting rates. I think the Fed, if anything, probably needs to raise rates. But I think it doesn't mean that the dollar couldn't go down because I think there's more discounted as to what could happen in Europe in terms of the ECB cutting rates. So, even if I don't think the Fed's going to be quick to hike rates, I think they probably should unless, but I think still that rate differential can move in favor of Europe. I think there are some things being contemplated by the Trump administration which are very risky. I know from certain members of the Trump administration that they believe the stakes are very high. They're related to dealing with the debt. They could be very dollar negative if they occur. I don't believe they're coming imminently. I don't believe they've been they just haven't got the people yet to pursue these, Maggie, but they're being talked about in the market.
So what are they? What are the?
There's one of them, for example, that would be so one of the big things is when you are the reserve currency, which the dollar is, you accrue certain advantages. The typical advantage is that people are happy to buy your debt. That tends to repress your yields and keep them artificially low. That tends to encourage excess borrowing. That tends to encourage excess deficits. So that's when you sort of get into the sort of bad side. And the bad side is that as part of this deal to be the reserve currency, you typically have to provide defense to the rest of the world, hence the expression Pax Romana, Pax Americana, Pax Britannia, right? Those, that's what you did. We'll defend you. It's expensive to defend you. You buy our debt, right? And then you buy our currency, and we're the reserve provider. So, but there are costs to that, and those costs are you typically run an excessively strong currency that tends to result in you hollowing out manufacturing, and you import a lot. And that's ultimately why the system becomes unstable. So one of the theses and one of the ideas being floated apparently is that the Trump administration doesn't want to do this for free anymore. They want to charge basically allies for the provision of security. And what the idea is that they will exchange that the Trump administration will go to them, and this debt is getting very big to keep paying for these bills. The Trump administration will go to them and say, we want you to exchange your treasuries for this brand new shiny treasury that has a duration of 100 years and pays no interest. So you give us, let's say, Germany, you've got 100 billion treasuries sitting in the Bundesbank. We're going to take these off you. We're going to give you a new treasury worth $100 billion. So face value, it's worth the same, but we're paying you no interest. And that's the cost of us providing you military coverage. Now, the problem with that is definitively a technical default. Because you net present value that bond with a face value of $100 million, let's say, over 100 years of zero interest rates, and the net present value on it is pennies on the dollar, right? So yeah, it helps the US debt situation theoretically, but we've seen these sorts of things in the past, and they are technical defaults. And
do you think
good.
that they're seriously considering this?
I know that one of the most senior guys in the administration believes that this is absolutely the last chance that the US has to address the deficit before it's unaddressable.
Well,
and if that means radical steps, and this is what we've been saying to clients, we've been saying that the Trump administration trade would go into 3 stages. Stage 1 would be assumption. Trump 2.0 looks like 1.0. Okay. So very strong equities, strong growth, bad for bonds, strong dollar, right? Then we would move in middle of December. We said a confirmation phase where you'd look for the data to kind of confirm this thesis that things were picking up. And you'd look at the soft data, in particular, things like the PMIs, and those all shot up. It's exactly what we got, Maggie. And then we said, there's reality. And reality could come as a big shock to markets, because certainly we believe that while there's an element of tariffs, which are a stick to beat people to get what you want, so those are negotiable, right? There's very, very much an element of tariffs which are purely revenue raising and designed as part of industrial policy.
right.
And there is literally no way that Trump is going to be able to even roll, let alone commit to his no tax on tips, et cetera, even roll the existing tax cuts without significant revenues from tariffs, because Doge just ain't going to do it yet. And it's not going to convince the fiscal hawks in Congress to pass that bill.
Yeah, well, also for them to do that, they've got to go after entitlements and defense, right? And that's just been
I mean, and look, you can see the embryonic steps there. These are big asks, right? There's talk of 800 billion coming out of Medicaid, right? We've had this opening gambit. Well, why don't you cut your spending 50% on defense, and we'll cut our spending 50% on defense, right? So I think we're in for a very, very radical period. And I don't think it's as positive for US stocks as people believe. I think people believe that Trump's audience is the equity market. Trump's audience, I believe, is the working men and women of America and the sanctity and the structural rigidity of the economy, because without that, you have no ability to defend yourself, right?
Mm.
So I think the good news is he's a capitalist, so he wants to grow the pie, but I think he wants more of that pie to go to workers and less to go to the C-suite. And I think one has to look at when we say, oh, look, China and Mexico are in the pillories, right? Those are the ones being blamed. They're the beneficiaries, sure, of globalization.
Mm.
Who made the decision to globalize? The C-suite.
Mm-hmm.
So somewhere along the lines, Maggie, the US C-suite is going to have to pay a price. And if they bring those jobs back on shore, it's not going to be as cheap as manufacturing in China.
Absolutely
The
not. We know
massive,
that.
you look at the division of GDP that's gone to workers since the collapse of the Berlin Wall in 89, the share of GDP that's gone to workers has done this, and the share that's gone to the C-suite has done this. And I think he's going to address these
Address
things.
that. Well, that's why he was elected. And
Right.
and you could argue there have been some that have argued, when we talk about this just out of the US lens, that if they don't, it will be the next person, because
Right.
it is the pendulum swinging and it's
Correct.
happening everywhere, not just the US, by the way. I'm assuming that is bad for stock, but negative for stock. So are you
I would say it's, look, as long as you can grow the pie, everyone's pie grows a little bit. But if 1% of the growth accrues to the C-suite and 20% accrues to workers, there's a difference. It makes a big difference as to what you own and what you do, right? I think there's a cost. There was a big benefit to outshoring everything, right? There's a cost to bringing it back on shore. I think it's pretty inflationary, arguably, right?
Well, that's the thing. It's not just the C-suite, right? It's
No.
also the workers because of the inflation. So you
Yeah,
don't
I
buy
mean,
that
as
it
long
would
as
just be a
as long
shock.
as their wages grow faster, right? You're in a self-perpetuating environment, and there's things that they want to try and do to ameliorate the pressure from inflation, like pump more oil. This is Scott Bessent's 333 thing, right? But this is not, you cannot get to a place where America goes back to a sort of economy which it had in, let's say, the late 80s or the late 60s, right? Where, everyone has a white picket fence and a car and a good standard of living and a job and all that security without taking pain up front.
Mm-hmm.
And I just don't think people realize what that means. And it probably means you need a quite significantly weaker dollar, right? And that means a loss of living standards for American workers on a comparative basis, right? Because there'll be no more jetting off to Santorini, right, for those super cheap holidays, right?
Someone said, I can't stand seeing all these Americans running around like Great Gatsby with a strong dollar, sort of vacationing everywhere. I want to go back. We have so many comments, and people really sort of, I think responding to the idea that we would sort of, in exchange for security, swap out treasuries for these 100 years and risk a technical default. J&J saying, why would the US and likely the West more broadly default on debt rather than just use yield curve control and financial repression?
So it's not, I mean, it's not a default, right? You're going to get paid back. But these things have happened. They did them after the First World War. There were suspensions or renegotiation of interest rates. yield coupons, let's say, so you go from, I don't know, the Bundesbank is sitting on a bunch of treasuries and the average yield on them, let's say, is 5%, right? If all of a sudden it's zero, but maybe they accept it because that's the cost of, Germany getting defended by the US if the Russians keep rolling from Ukraine onwards, right? Then maybe that's not a default. But yield curve control comes with lots of other difficult consequences. You've got to, for start, you've got to coerce the Fed to do it. And theoretically, the Fed is independent.
You also, you've got to get a whole host of people on board as well, to go along with that. What about, so what's your sense in terms of Europe, though? You assume under that plan that they'd accept that.
Well, they might just go, right?
Right. And because this is one of the things that came up this week. We've been talking about all of the different, and I had a very interesting conversation. People seem very divided, not divided, but unsure of what could happen. And the scenarios are very wide, right? So I've talked to people, and Europe's a perfect example of that. I've talked to people who think that Europe is over, that they are, they've kind of given away their energy independence. It's going to take years to build that back. They could see a scenario where the EU does not continue as a going concern. They can see a situation where Germany does not continue as a united. Now that is probably the most provocative stance, but there are people who are very bearish the future of Europe because of some structural things. So, and then on the other hand, I see people saying to me just this week, listen, the US has basically said you've got to pay for your own defense. So you could see spending ramped up in Europe. They blow out their budgets because they've got to reestablish their own security and energy, solve that problem. So you could see spending, which grows the European economy.
Right. So if I look at Europe, we wrote a piece at the end of last year called Peak Pessimism. And just the view was literally, if you do a couple of surveys you can look at, you had never, ever, ever seen people more bearish on European stocks and more bullish on US stocks in like 40 years. Never, right? So if you're a contrarian, like a lot of macro guys are, you're like, ooh. So that was classic. That was classic. So firstly, positioning was bad. Positioning was very extreme. So as I said to you at the beginning, I think a lot of what we're seeing at the moment is positioning, Maggie. We're seeing these flows, that people were very overweight US stocks, very underweight European stocks, very short the dollar, very long the dollar, now are being squeezed out of some of these trades. The question, the next bit is does this turn in for more than just a bounce, right? So does the euro go from 101.5 to 106, and then the next thing is 104, 102, 1, right? And I think a lot of that depends on what comes next, and that's quite hard. If you do a peace deal in the Ukraine, particularly if you force it down the Europeans' throat, which appears to be the likely scenario, and you force them then to pay for the rebuilding of Ukraine, right? Then you are talking an inordinate amount of money, right? That's going to be spent by the Europeans. And it is going to be spent in a very belligerent kind of way, where they're not feeling overly fluffy towards the United States, right? Maybe they spend it. Maybe they say, up yours, Mr. Trump, and he slaps on big tariffs, right? But I suspect what they would do is probably spend it. That is pretty bullish in an economy where I know everyone thinks it's done, but unemployment is sitting at the absolute arse lows, and their inflation is showing signs of picking up. And they only have a central bank that cares about one thing, inflation, right? So I think that it's very, very dangerous to get arrogant about the US exceptionalism trade, where, as I said on a conference call that I was on earlier, if exceptionalism is spending money like a drunken sailor, then we're pretty exceptional, right? We're pretty exceptional. Where the whole world is funding our extravagance by buying our assets. So we are literally, Maggie, selling off our Nvidia stock. I wouldn't call treasuries, the family silver, right? But we are selling US assets so that millennial influencers can go and stand on a cliff in Santorini and take a picture and ruin it for everyone else who lives there. Right? I mean, it's that simple. We are living way beyond our means. So if you force Europeans to start spending money to defend themselves or repair Ukraine, where is the money?
It repatriated back from US assets.
It's here.
Right.
It's all here. It's all here, Maggie. And never in the last 50, 60 years, has the US been more dependent on asset prices to underpin the economy. From everything from consumption being driven by wealth, perceived wealth, because they haven't liquidated those assets, right? They're only paper, so they're looking at their brokerage statements and going, "Sure, we'll go out for dinner, darling. I made another $1,000 today." Well, you didn't, mate, because until it's sitting in your bank account in hard cash, it's just it's monopoly money, right? To jobs being created on this perception that company stocks is going to go up forever so they can afford to hire some more people, right? There's an inherent fragility here if you start demanding that other people spend money, right? Because they have been lending it to us so that we could spend money.
So I just want you to reiterate that, because I think this is something that gets lost. Because I think that people like the fact that this administration is standing up for what they think is the rest of the world kind of taking for granted, the fact that we police things, however it's phrased. People tend to think about the vulnerabilities of US treasuries. We've had in the past when we've gotten into a tussle with the Chinese, they threatened to sell some treasuries. People don't think of it in terms of stocks. So you're saying that we are at part of the sort of game here when you're asking for other people to pick up that money has to come from somewhere. Just repeat that for me, because I think it was so important.
So yeah, I mean, look, if we run foreigners are very nice to fund about a third of our budget deficit, okay? But that's relatively small fry on an ongoing basis, on an incremental basis to what they have to do to the current account deficit. So when you go and buy a BMW from Germany, right, you have to pay for it with euros, right? You pay for it in dollars, but they go and sell those dollars and buy euros and ship them over, right? Now, how do you get those euros, right? You can borrow them. So an American bank could go to a German bank and they can borrow that money. Or we can get them because a European buys a US asset with euros, right? And basically that's where the matching off of the trade goes through, right? So US banks borrowed a little bit in 2020, 2022, but not much, right? So what is really happening is the foreigners are buying US assets. Now, some of that is very good. Some of it's foreign direct investment. So they're building factories here. That's great. But their holdings of US treasuries relatively have been going down. Mm-hmm. And their holdings of US stocks relatively have been going up, right? We all know that the SNB, the Swiss National Bank, doesn't buy as many treasuries more, right? Because they own Apple stock and Microsoft stock, right? Now, that's great. It's been a great trade, but it's in a more volatile asset, and it's being held not only by central banks who've got sticky hands, maybe, but by individuals, right? Mr. and Mrs. Schmidt sitting in Dusseldorf are foregoing consumption today to fund, whatever, little Johnny in Arkansas so he can sod off to Santorini and stand on the cliff, right? I mean, that's literally what is happening, Maggie. So this is fine as long as the game keeps going, but it's like the stability is that of a three-legged stool. It's very dependent on three things. Firstly, it's very dependent on the strength of the dollar because the money has been lent to us, or we bought assets unhedged. Otherwise, we couldn't take that money and go to Santorini, right? So Europeans basically have a long Nvidia position in euros. So if one day the euro goes from 102 to 120, right? A 20% move almost, right? Mr. and Mrs. Schmidt go, oh, my Nvidia is down 10%. Well, Nvidia might be up 10%, but they've lost 20% on the currency, right? And then they might sell, and then the money goes home. Secondly, they can't ask for that money back, right? If they need that money in Europe because they retire, Germany needs that money to pay to defense, and they start issuing more debt at higher rates and so on and forth, the money goes home, right? Thirdly, the US economy has to remain very strong because it has to keep sucking in that money. But we've already talked about if the equity market were to show signs of faltering, there's a fragility here that's very dependent on wealth. And so there's and God forbid we wake up and we find that the ROI on these hyperscalers is not what we thought it was, Maggie, right? Or that suddenly we're going to start piling into commodities because the dollar's weakening, right? Well, the US is a growth equity market, right? It is not a value equity market. The US equity market may not go down, but it won't go up as much as Brazil might go up, right? Or Australia might go up, or New Zealand might go up, or Canada might go up in an environment where the dollar is weak and commodities are strong. So there's a game going on. There's this massive flushing sound of cash, right? That keeps piling money into the US, right? Mike Green talks a lot about the indexation, but that's in a way that drives these certain stocks certain ways. But my view is on top of that, and actually funneling big money into that, is this macro trend, which is just massive vendor financing of US overconsumption. And if all of a sudden we demand that other people start consuming, whether it's on defense, whether it's on, rebuilding Ukraine, they need the money, and we are the global piggy bank.
And so you see this macro, you see a higher risk that this macro trend swings, and we have money moving out of US assets.
Yeah, I think there are some things being done by the administration that could trigger that move, right? It's if you connect the dots, I think there are some things that potentially could start to change that trend, Maggie. Yes.
And somebody in the chat said, well, money goes where it's treated well. Is that a
sorry, money goes
recency
where?
bias type of that the US is the best place for investment because it's liquid and it has the companies and all of that sort of?
No, I mean, look, if Europe has to spend 5% of GDP on defense, if it has to spend 3 trillion euros, which is the number being bandied around, on rebuilding Ukraine, they're going to have to offer returns which incite investors to put the money back there. So bund yields would have to rise, and maybe they issue some euro denominated debt, for reconstruction loans or something like that, right? And they will have to raise those rates to the point that the money starts to go home, right? And by the way, European stocks are incredibly cheap. And you can argue, well, they're incredibly cheap because the returns aren't there. But suddenly, if you're reconstructing Europe, maybe the returns are there, right? It's a relative game.
Mm.
right? And if I need to relatively get my money because you've just demanded to me, US, that I've got to spend it on, defense, so I've got to rebuild Ukraine, and I can't trust you, you're not going to leg me over again, the US, right? I mean, I think the biggest weakness I see in this sort of debt swap idea is, okay, so I'm going to take 100-year bond promissory note, and fine, I'll take the haircut, but I can believe that in 100 years you're going to come and defend me. I can't believe in a 4-year period from one administration to the next that you're going to come and defend me, right? So I think there are all sorts of potential problems. What I know, Maggie, is that all the money is here. It's taking an increasingly large amount of the money to keep consuming the US. It is causing domestic problems. It's keeping the dollar too strong. It's hurting US manufacturing. It's encouraging you, America, to spend too much money. That weakens the US long term, right? All of these factors are coming to a head. It just needs a little push. Now, is a weakening dollar that little push? Is forcing Europe to expand growth that little push, right?
Mm.
Is
Yeah.
tariffs that little push? I don't know.
So let me ask you, let's do a wrap around because we're almost out of time.
Yeah.
Do you see Jonas asking this? I'm going to shorten it. Do you see a recession inevitable here in the U.S.? We have deportations, we have tariffs, we have Doge austerity. Do you see a recession?
Not yet. Not yet. If anything, the biggest risk to the US is that growth is re-accelerating. Absent we get that imminent equity correction, growth is re-accelerating. And if anything, the biggest risk is that the Fed will have to raise rates again. And that's when the inflation risk, that's when the recession risk rises. Not yet, though.
Not yet. Is there a chance that you see inflation rising? Is there a chance that Trump's policies taken together are actually deflationary, not inflationary?
No.
Okay. There's debate on that because
No, I mean, look,
yeah.
weakening the dollar is massively inflationary. Immigration, curtailing immigration when you have 4% unemployment is massively inflationary. We have never accelerated growth from 4% unemployment without stoking inflation. Never, right? So, maybe this time we're lucky, right? And tariffs, at least for a year, are massively inflationary.
So you've taken off your gold because you felt you're at the level to take profits, but where do you
It's just
hide
a
when this happens?
trading. It's just a trading view.
Yeah. But where
I think you still hide in gold. As I said, I don't know whether I said it off screen or what, like PA. So for my personal account, I haven't sold any, but for our trading account, we've sold some. We've sold it. We took profit.
Yeah.
We were long from like just under 2,000. So it's been a 30% run. It's been pretty damn good.
Yeah, Adam, I think you misunderstood. He just said the world would go into recession, but Trump can't create deflation. No, he said there would not be a recession short term.
Not short term, no.
Which is
I
why
don't
it's
think.
going to be inflationary.
I think I think the Fed is running ridiculously easy policy. I think the risk is actually that inflation ends up absent an imminent correction in stocks. I think the risk is US inflation is going to pick up, and then the Fed is going to be forced to slam us into a recession, and that or not. And if the or not, then that's quite a different trade, Maggie, right? Then I'm going to buy even more gold and sell even more treasuries.
And do you see? It sounds like you're very bearish U.S. equities, or not yet.
I'm not. Look, I'm not. I took some profit on US equities. I put it into gold. I think gold is outperforming US equities. As I said, tactically, I'd like to get a little pullback in gold so I can buy some more. I think US equities are very, very overpriced. I think there is a risk that we're beginning to see, and DeepSeek is a classic example of that the valuations that we've ascribed to US assets are just wrong, right? So if the Chinese can produce it for 10 cents on the dollar, it's wrong. There was a great story in the Wall Street Journal about Chinese drug companies being bought by big pharma for a few $100 million versus the billions of dollars that they was paying for unicorn startups in the US, right? I think, I think there were lots of things, Maggie, that I think we may have just paid too much for.
Yeah. This is a tough right. We didn't even get a chance to talk about oil, but we'll talk about it next time. Julian, it's always not only educational but entertaining when we catch up. Somebody was suggesting that you needed a holiday. Guess what? He just came back from one.
I just came back from one, yeah. I
Yeah.
mean, you never get a holiday in this business. The only time you get a holiday is sort of Christmas, because I think the market's getting old enough now that they're like, screw it, I'm going to go and take the week off.
At least there's still that. Yeah, because now it's absolutely true. And forget about summer because this is an administration that is moving fast and
Yeah.
attempting to do big things. So
Yes.
it's going to be absolutely crazy. Adam, I'm sorry. Oil, just up or down, Julian?
It's actually, Adam, look at a logged weekly chart of oil. It is in a wedge like this, right? So just wait for it to break, mate. You don't have to make a call here.
Yeah, exactly. Especially with all of what's going on, watching the headlines with Ukraine. Julian, remind everybody. We'll put the link in the description again. But where can they find your work? You do a
So, if you're an institutional investor, you can reach out to MI2 Partners. So support at mi2partners.com. If
you have a
you're,
note or something, right? I forget what it's called again, though.
have you got it? So
Mac-
if we've got our new retail product, macro capture.
Capture, that was it. I knew.
Yep, macro capture is a new retail product. We had obviously the deal with Raoul for a long time. It worked well, and then we sort of diverged. Macro, Raoul having had some very good calls, became sort of crypto all the time, and it's really not macro as far as I can figure out. Great trade, but it ain't macro. And so we went our separate ways. So now we've got that. And so, if you're interested in that, you can either go on the website, the MI2 website, sign up for that, or which again, reach out to support. And if you just want to follow me on Twitter, it's at Julian MI2.
Right. And I tagged him today when we were going on air, and we'll put this out as well. Fantastic stuff. Julian, thank you so much. Happy Valentine's Day, everyone. I hope you are.
And you're wearing pink,
I am.
Maggie.
I know.
And the nice thing is I bought my fiance flowers during the week. So I'm off the hook now, and we're going to see a comedy show tonight, actually.
Oh, that's perfect. Actually, this is exactly what you need in this kind of environment, is to go to a comedy show. What's your drink of the night, do you think, Julian? Because lots of people are sharing theirs in the chat.
I'm a red wine man. As I've got older, I love a gin and tonic during the summer. Got a glass of champagne, but I'm really a red wine man.
Yeah, well, it's a good time for it because it's cold.
Yes.
I hope you all enjoy. I am purely sticking with the bubbly tonight. It just seems like the appropriate thing to do on Valentine's Day. But I hope you all enjoy whatever you have planned for the weekend. And it's a long one, too, for a lot of folks here in the U.S., which means that we will not be broadcasting on Monday, but we will be back with you next week. So have a great weekend, everybody. Thanks so much. Take care and good luck out there.
Bye.